Welcome to the Deep Dive. We're your shortcut to understanding what really matters in some of the world's, well, most complex sources.
And today, we're tackling something of a puzzle from the financial world, the year 2022.
Right, 2022, what a year.
Oh, yeah. Arguably one of the toughest environments we've seen in a long time. You had U.S. inflation hitting, what, a 40-year high?
Mm-hmm.
The Fed hiking rates faster than they had in decades. And the S&P 500 down nearly 20%.
Yeah, just wiped out. It was sort of a perfect storm, wasn't it? Volatility, geopolitical stuff, this really severe economic tightening.
Exactly. And in that kind of environment, you'd normally expect the big financial institutions to be, well, hurting badly.
You'd think so. Panic buttons, right. But as we dug into the sources, specifically looking at Morgan Stanley's 2022 performance review, the story is, well, it's completely different.
It really is. Despite everything we just described, they delivered what they actually called strong results.
Strong results being the second highest net income in the company's entire history.
Astonishing, really. The raw number was $53.7 billion in total net revenues.
So the big question for us, our mission for this deep dive, is how? How did this massive strategic transformation they've been working on for a decade actually insulate them?
Yeah, how did that shift let them navigate the chaos that hammered so much of the market?
Okay, so let's start right there. Let's unpack this transformation, because that seems to be the foundation, the structure that let them ride out the storm.
It wasn't just small tweaks either. This was a deliberate, calculated effort.
Yeah.
And it really accelerated with those two huge acquisitions.
E-Trade.
Right, E-Trade for the wealth management side and Eaton Vance for investment management.
And the idea was to build, what, a more balanced business?
Exactly, a financial fortress, you could say, something less reliant on the ups and downs of traditional investment banking. The sources, they really emphasize this point. Now, about half their pre-tax profit comes from wealth and investment management combined.
Half. That's a big shift.
It is, and it's expected to grow. The thinking is it makes the whole firm less cyclical. Client fees, asset management revenue that tends to be stickier, more predictable than, say, underwriting fees, especially when markets seize up like they did in 22.
Okay, so the theory sounds good, diversification, stability. But 2022 was the real test, wasn't it?
Absolutely. The proof is in the pudding, or in this case, the financial results. Look at their capital discipline. They kept their common equity tier 1 ratio, the CET1 ratio, at 15.3%.
And just to remind everyone, that CET1 number, it's a key measure regulators use. It shows a bank's capacity to absorb unexpected losses, keeping it that strong through that year.
It signals really conservative risk management. Very disciplined.
Right. But it wasn't just about being conservative. They were also profitable.
That's the other side of the coin, achieving that capital strength while also delivering impressive profitability. They hit a return on average tangible common equity ROTCE of 15.3%.
Which is the metric they use internally, right?
Yeah.
To measure how well they're using shareholder money.
Precisely. Hitting that kind of target, especially with all the economic pressure, it says their operating model isn't just defensive, it's fundamentally sound. It works.
And they weren't just hoarding capital either. They were actually returning it.
Yeah, quite a bit, actually.
Huh.
About 9% of their capital went back to shareholders, mostly through share buybacks. That was around $10 billion, plus a dividend yield of about 3%.
So the message to the market was clear. Discipline and stability translate into value, even when things look grim overall.
Okay, so let's shift gears a bit. Let's look at the institutional securities division, the traditional investment bank.
Right. This is where you'd expect to see the direct impact of that 2022 environment.
And you do. The total revenue there was $24.4 billion. But it was very much a tale of two halves, one part booming, the other, well, frozen solid.
Let's start with the frozen part, investment banking. The sources said revenues were significantly lower.
Yeah, the CEO called it an anemic underwriting calendar. Basically, deal flow just dried up. IPOs, debt offerings.
The worst underwriting calendar in 10 years, I think was the quote. Why? Why did businesses suddenly stop wanting to come to market?
Well, it boiled down to valuation and uncertainty mostly. When rates shoot up that fast, asset values get hammered. So sellers just weren't willing to launch deals at those depressed prices.
Makes sense.
And the uncertainty just made everyone hit pause. So the pipeline stalled completely. This is exactly where that old, maybe more volatile investment banking model really struggles.
But then there's the counterbalance, the other half of the story in institutional security.
Right, the hedge that's built into their structure now. Fixed income, currency, and commodities trading. FICC.
While investment banking tanked, fixed income had its best year in over a decade.
Yeah. And what's really crucial to understand here is why. The same volatility that killed underwriting. That's exactly what fueled fixed income.
How?
Well, when central banks are hiking rates aggressively, clients think corporations, asset managers, hedge funds, they have to react. They need to manage their interest rate risk, their currency exposures, their credit positions. They need to trade.
So the chaos creates demand for trading services.
Exactly. And Morgan Stanley had apparently made some smart strategic investments in that franchise over the years, modernized it. And it paid off massively in 22.
Huh.
They became the go-to place for clients trying to manage the uncertainty, the fear.
So it really acts like a strategic stabilizer. Markets calm, rates low, investment banking does well, Fed slams on the brakes, markets go wild, trading desks pick up the slack.
That's the idea. Capturing revenue on both sides of the cycle. It shows why they're still a top 3 global player. Even in these trickier, more capital-light businesses, they can defend their share.
Okay, so institutional securities navigated the storm partly thanks to that fixed income performance. But if that's the engine for managing market risk.
Then the real long-term anchor, the growth engine, is wealth management.
Right. Let's pivot to that, the wealth management segment, or WM. It wasn't just stable in 2022, it was setting records.
Yeah, records. $24.4 billion in revenue and a pre-tax margin of 27.0%. Really strong numbers.
But the stat that really jumped out at me, especially given the market carnage, net new assets, NNA.
Oh, yeah, the NNA figure is maybe the most revealing metric of the whole year. They brought in $311 billion. Billion dollars. With a B.
Think about that. Existing client assets are getting hammered because, indices are down 20% plus, yet they're attracting almost $1/3 trillion in new money.
It's way more than just client confidence, isn't it? It points to something structural, a powerful advantage they've built.
So what is it? What specific levers let them pull in that kind of cash when everyone else is panicking?
Well, it's that category of one strategy they talk about. It's the integrated model, using everything they've built, especially leveraging that E-Trade acquisition. You combine the traditional advisor-led approach with the modern self-directed platform.
Okay, integration helps, but is there a secret weapon?
There seems to be. The sources really highlight the workplace channel. Morgan Stanley at work.
Explain that. How does the workplace channel act as a feeder system?
Well, think about it. Morgan Stanley manages retirement plans, stock plans for huge companies. So you have lots of employees with stock options, deferred comp, 401k sitting there.
Okay.
Then the market tanks. Suddenly, those employees see maybe a big chunk of their net worth, often concentrated in their company stock, getting crushed. They start looking for advice. They want a safe harbor. Consolidation.
And Morgan Stanley is right there managing the plan already, perfectly positioned.
Exactly. It becomes a kind of panic consolidation conduit. And we saw a specific number on this. Between 2020 and 2022, something like $150 billion in assets migrated from those basic workplace accounts into the full-service advice channel.
Wow. So those are passive assets becoming active, revenue-generating relationships.
That's the engine. And this strategy also feeds the investment management, or IM segment, too.
Right, the Eaton Vance side of things.
Yeah. IM reported, $5.4 billion in revenues, holds $1.3 trillion in assets under management, AUM. Integrating Eaton Vance gave them instant scale and diversification there, pulling in those durable asset management fees.
And within IM, they're focusing on specific growth areas, aren't they?
Definitely. High growth, potentially high margin areas. They mentioned alternatives, things like private credit, real assets. They have about $210 billion of investable capital there.
Alternatives are huge right now.
They are. Plus, customization and sustainability. Big client demand drivers.
Customization? You mean like tailored portfolios?
Exactly. Parametric, which came with Eaton Vance, is the key example here.
Yeah.
They do highly customized solutions. And since the acquisition was announced, Parametric apparently brought in net inflows equal to about 30% of its starting AUM.
30% inflow, that's massive growth.
It really is. It shows clients increasingly want strategies tailored just for them, not just off-the-shelf funds.
Okay, so let's zoom out. You have wealth management and investment management working together, this whole client ecosystem. At the end of 2022, combined client assets were $5.5 trillion.
A huge number. And that leads directly to their big, audacious goal.
The $10 trillion target.
Yep. Growing those combined WM and IM assets to $10 trillion. That seems to be the ultimate benchmark for their success going forward.
That goal, $10 trillion, it must shape everything they do now.
Absolutely.
Yeah.
Which brings us nicely to the final piece of the puzzle, the people. The leadership, the talent, the succession planning needed to actually manage a firm aiming for that kind of scale.
They talk a lot about investing in people, culture, diversity.
And they have some metrics to back it up, like 38% women in the new managing director class, their highest ever. The operating committee is 20% women, 40% ethnically diverse. They mention things like the Institute of Inclusion's Talent Accelerator.
Okay, those are important signals. But the recent executive changes seem even more revealing about how they're preparing for the future.
Yeah, this is where it gets really interesting strategically. Several very senior, seasoned executives stepped down recently. The COO, head of external affairs.
Normally that might look like instability.
Right. But the CEO explicitly framed it as a positive thing, an opportunity, not just retirements, but an intentional move to broaden the experience of the next generation of leaders.
So, strategic shuffles, giving people new, bigger roles.
Exactly. For example, the chief legal officer also became the chief administrative officer. Other top leaders took on expanded responsibilities across global operations, technology, risk.
That sounds complex and risky. You're taking experts in one field, say law, and giving them massive operational jobs during a pretty tricky economic time.
The risk is definitely there.
Yeah.
No doubt. But the management philosophy seems tied directly back to that $10 trillion goal.
How so?
Well, think about managing a firm of that scale. Globally diversified, meaning huge tech integration between wealth, investment management, institutional. You can't have leaders stuck in silos.
You need generalists at the top.
You need people who understand the whole picture. Global risk, tech integration, operational efficiency all at once. So they're basically testing their bench, putting potential future leaders under pressure, forcing them to develop that broader perspective.
A very high-stakes form of on-the-job training, then.
Pretty much.
Yeah.
And crucially, the current CEO has been very clear. He expects his successor will come from inside the firm.
Right. That commitment to methodical internal succession planning, it signals they see leadership development itself as a core strategic advantage, like fixed income trading or wealth management.
Yeah, I think that's right. So if you put all these pieces together, the balanced business model, how they navigated 22, the huge $10 trillion ambition, and this deliberate leadership development.
It tells a story, doesn't it? A story of a firm that intentionally built a structure not just to survive disruption, but maybe even to thrive on it.
That seems to be the core takeaway. This decade-long transformation created a uniquely balanced firm, a category of one, as they like to say, and 2022 proved the model works, letting them achieve that near-record income during a meltdown.
And the focus now is relentlessly forward, growing those client assets towards $10 trillion, underpinned by operational discipline and this careful cultivation of future leaders.
And just to loop back quickly to the wider world, the sources mentioned the CEO's view on those regional banking issues in early 2023, the ones linked to the rate hikes.
Right, Silicon Valley Bank and the others.
Morgan Stanley's view was apparently quite firm. Those were idiosyncratic problems, unique to those specific banks, not systemic issues threatening the whole system.
And that confidence presumably comes directly from the strength and diversification of their own model that we've been discussing.
Exactly. That structural strength breeds confidence. So for you, the listener, here's where we want to leave you, our final provocative thought.
Considering the sheer scale of that $10 trillion asset goal and the firm's strategy of forging its next leaders through these really demanding cross-functional roles, which single management skill do you think will be the absolute most critical for the next CEO?
Is it the discipline? Is it mastering technological adoption and integration across all those platforms? Or is it superior risk mitigation in an increasingly complex world?
What's the one trait they absolutely must have to hit that monumental target?
It's the kind of question that could define their success for the next decade, whether they reach $10 trillion or, stall out somewhere lower.
Something to chew on. Thanks for diving in with us today.
Yeah, thanks everyone.
We'll see you next time for the next deep dive.